Hello, Eagle investors. This is Samuel here to talk about portfolio balance, specifically in an active options portfolio. I'm excited to take this new mini series. But before we get started, if you haven't already, make sure to like and smash the subscription and notification bell below. Also check out Eagle Investors, a growing online community of options and stock traders, in the description below. This first video on portfolio balance will cover what is known as the Greeks and how we can hedge them. Many factors determine options price. Some important measures, not just for individual positions, but portfolio balance, are known as the Greeks. Getting started, there are 5 main Greeks, 4 of which we will dive into. Each has a different meaning and importance, but understanding them holistically helps us analyze our portfolio and position risk. Greek values in options trading are extremely important as they allow us to have a mathematical understanding of our positions and help gauge our true risk. We will be covering delta, theta, gamma, and Vega, as well as how to hedge these in your portfolio. We are not covering rho as this value is less pressing, particularly in a low interest rate environment. First up, we have delta, widely recognized and regarded as the most important of the Greeks. Delta is the rate of change of an options price with respect to the price of the underlying. Delta can be positive or negative. Deltas can also be thought of as the probability that the option will expire in the money. Having a delta neutral portfolio can be a great way to mitigate directional risk from market moves. This means balancing bullish and bearish positions and weighing them accordingly. Next up, we have theta. Theta measures the rate of change in an options price relative to time. This is also referred to as time decay. Theta values are negative in long option positions and positive in short option positions. Initially, out-of-the-money options have a faster rate of theta decay than at-the-money options, but as expiration nears, the rate of theta decay for out-of-the-money options slows, and the at-the-money options begin to experience theta decay at a faster rate. This is particularly important to understand when swinging short-term options. One way to balance your portfolio's theta is to mix up both credit and debit strategies. At Eagle Investors, we have traders and investors of all sorts that do all different strategies from credit, debit, and complex multi-leg positions as well. Moving on, gamma. Gamma can be a little bit tricky, but gamma is the rate of change in the delta of an option. Gamma values are the largest in at-the-money options and smallest in the money and out-of-the-money options. Gamma sensitivity exponentially increases as expiration nears. Gamma is important to keep in mind when hedging deltas because low gamma positions require less maintenance than high gamma positions. One way to reduce the risk is managing early. Gamma hedging attempts to reduce or eliminate the risk created by changes in an option's delta. Next up, we have Vega. Vega, though not even a real Greek letter, is a Greek metric that allows us to see our exposure to changes in implied volatility. As you should know, and we'll make sure to cover in a different series, implied volatility is the market's forecast of a likely movement in a security's price. Vega values represent the change in an options price given a 1% move in implied volatility, all else equal. To hedge Vega, it is necessary to use a combination of buying and selling puts and calls. A good way to limit volatility risk is by using spreads. I hope you enjoyed this first video on portfolio balance and hedging the Greeks. Comment below your thoughts and methods for hedging the Greeks in your own portfolio. And again, make sure to like and subscribe. Join the Discord in the description below. Next up, we will have portfolio balance, sizing for success.